Good afternoon.
Good afternoon.
Okay, sorry. We say that in this class we will start off by discussing on foreign currency risk management. On foreign currency risk management, I'll go straight. Okay. When it comes to the foreign currency, okay, let me introduce by discussing what an exchange rate. Okay. So an exchange rate simply is a quotation, or simply is the price of one currency over the other. Okay, or call a quotation. Okay. So, for example, you're going to be quoting Kenya shilling versus US dollar. We say that one US dollar is equal to, okay, let's say 108 Kenya shilling. Okay, then we refer to that as what we call the direct quotation. Okay, where okay the price of $1, okay, compared to the case of Kenya shilling is equal to 108. Okay, in this example, this was at 78. Okay. Then, if again, because don't forget here what is happening is the market we are in is Kenyan shilling. Okay, therefore the currency for Kenyan context is Kenyan shilling. Okay, so in case you're going to be having, we have called the price and the base currency. So if the foreign currency, okay, in this case the US dollar, okay, is the 1 unit, okay, 1 unit of foreign currency is equal to X amount of the local currency, then we could refer to that as the direct quotation system. Okay, then you can have a case where we say that 1 Kenyan shilling is equal to let's say 1 over 108 of a US dollar. Okay, that is where now the local currency, in this case the Kenyan shilling, okay, is the 1 unit, okay, then refer to that quotation as the indirect quotation system. Okay, so you have direct quotation system and you have the indirect quotation system. Okay, so both can be given at any point in time. Okay, both can be given at any point in time. Then we have to call the exchange rate. So there are three exchange rates which we need to become aware of. We have called the spot, we have the future spot, and we have the forward. Now the spot is if we are to go to the market today, okay, at the spot today, okay, then how much are you required to pay for $1 US? Okay, let's do that. Let's do that right now. Let's go to Equity Bank. We see how much you can pay, how much you're required to pay if you are to get $1 US. Okay, so let me just share Equity Bank Kenya. Okay, we'll call the spot market Equity Bank Kenya. Now, what is the Equity Bank Kenya? Who is Kenya? Country Kenya. So it's to give us what I want. Okay, for example, this is the spot. Okay, we can see here the currency. Okay, this is called the spot. Okay, that if you have to go today, okay, and you want to buy $1 US, then Equity Bank is telling you that you're going to be selling it to you at 113.75. Okay, if you want to, or if you want us to buy from you, then you're going to be buying $1 US, okay, at 106.55. Okay. Refer to as the spot market. That is, in case you go to do Equity Bank today, right now, then that's be the quotation you'll be given. Okay, that refer to as the spot market. Okay, that refer to as the spot market. And of course, you see this quotation is US is this called referred as the direct quotation because the US dollar is quoted as what we call the unit currency. Okay, they refer to the spot market. Now, the rates that will be applicable, okay, the exchange applicable tomorrow, okay, is referred to as the future spot market, okay. So, in case you have to go tomorrow, okay, to Equity Bank, okay, and you have $1 US, you want to sell to them, and they're going to be giving you the rate. No, they're going to be giving you the rates for tomorrow, not for today. Okay, that is for tomorrow. Okay, therefore, the rate to be given tomorrow, okay, for a future date is referred to as a future spot rate. The forward rate is the rate to be applied tomorrow, but agreed upon today. Okay, so you agree today that tomorrow I'll be sent to you $1,000 US. So you agree with the bank that for every $1 which you're going to be selling to the bank, okay, the bank will be buying from you at X unit, at X, let's say at 102 shilling. Okay, so you agree the rate to be applied in the future, but you agree it today. Okay, we'll call the forward rate. Okay, so you agree on the rate to be applied in the future today. Okay, we call the forward rate. Okay, now they're both rate to the future spot rate and the forward rate are rate to be applied in the future. Okay, they are rate to be applied in the future, but the future spot rate, okay, is the rate that will be applicable then at the spot market. Okay, at the market then. Okay, forward rate is a rate to be applied in the future but agreed upon in advance. Agreed upon, for example, today. Okay, clear on the difference, Nafisa?
Yes, sir.
Okay, go through this example, then we.
Question.
Yes, it's Brian.
Just go back to the slide. Sorry.
There you go.
So you're saying the future spot rate is, let's say, 3 months from now. The future spot rate is whatever that the exchange rate will be at that time.
Yes.
The forward rate is me saying 3 months from now I want to sell you $1 at maybe 120.
Yes, so you agree
I'm
today.
not sure.
Yes, that's the way. Yes.
Okay, thanks.
Okay, great. Okay, so go through the example we discussed together. Okay, in this example, you know that we have two people here, a UK exporter and an importer. So it's worth enough you understand what position do you have the parties in question? So first we begin with an exporter that we therefore they're going to be receiving payment in Danish krona, okay, of course, therefore, which is a foreign currency to them, because this is a UK exporter, and their local currency is the sterling pound, okay. So definitely, therefore, don't forget you want to convert to the home country currency of this UK exporter, which is sterling pound, okay. So upon the receipt of 150 kronas from the customer, what do you do with the kronas? You don't need them, okay? They're not applicable in your market as per se. Therefore, you convert them to the sterling pound, okay? Therefore, you're selling to the bank the kronas. The bank, in short, is buying them from you, okay? The bank is buying the krona from you, in short, okay? Therefore, we use a quotation that results the bank. Don't forget, first thing you have to note when it comes to the foreign currency exchange that the bank must make the money, okay? The house always win, okay? I think you have heard that rule before, okay? The same applies even in the foreign currency market, okay? The bank must make money. Just as I think we have seen with the equity bank is going to be buying from you a dollar at 106, then sell the same dollar to you at 113. So the difference is what referred to as the profit, okay? Therefore, the same thing applies when here, okay? Therefore, use a quotation that is what the bank making money from you. Therefore, since the bank is going to, since you're going to present the krona to the bank is giving the pound in exchange, then we use a quotation that is what you get in less pounds. Okay, we get that clear. Okay, we use a quotation that is what you get in less pound. Don't forget here we are dividing. Okay, because as per the quotation given there, Danish krona to the pound, the Danish krona is weaker than the pound, weaker in quote. Okay, for the quotation given there. Therefore, Nafisa, do you use the first quotation or the second quotation to convert the? Sorry.
Second.
We use second quotation, therefore. You see, we divide, therefore, the amount that you'll be receiving, therefore, will be equal to 150,000 krona. Therefore, the receipt, therefore, will be equal to 150,000 krona. We divide by 9.5, 9.583. We get how many pounds, therefore?
15,726.567.
15,005?
15,567.
567?
Sorry. 15,726.
Oh, 726.
Yeah.
726.
567.
Okay, so 527. Okay, I'm called 527. Okay, that's the amount you'll be receiving in sterling pound. In the other example, you are an importer, therefore, you're going to be your supplier is a Japanese company. They want to be paid in yen. Therefore, you're going to go to the bank, you go with your pounds to the bank give you the yen. So therefore, use a quotation that is what you giving to the bank more pounds, definitely. Because you're the one giving the bank the pound, then the bank give you the krona, then you pay your supplier. Okay. Therefore, the same applies here. That you're going to use the quotation that is what you receiving paying more. Because you don't forget here you're paying. Okay, don't forget you're paying. We use a quotation that is what you're paying more. Therefore, Brian, the second quotation, which one do you use?
First.
The first quotation, definitely. Therefore, divided by 203.650. You get how many pounds? 4,000.
4,910.35.
9.3. Okay. For the amount you're going to be paying to the bank, okay, for the bank to give you the 1 million yen. Clear? Don't forget, if you ever get confused on what quotation do I use, okay? Should I use the sell or the buy rate, okay? Simply use of, don't forget, the house always win, okay? That's a simple rule that you normally use, okay? Now, the foreign currency risk that we are more concerned with is called the transaction risk. However, we have other risk, okay, that we ought to be concerned with, or called the economic risk and the translation risk, okay? Now, the risk of the transaction risk is about what you just done, the importation and the exportation. You need to pay a supplier in foreign currency. You'll be receiving money in foreign currency. So it's simply because of I would call the transaction making, okay? The buying and the selling of your usual commodities, okay? We call the risk of the transaction, okay? And the risk comes in where we have called adverse movement of the rate compared to your position, okay? So if, for example, currently, okay, let's use this example of KQ. Okay, at the point of the transaction, okay, the KQ, the amount the KQ is meant to be in cash shilling, okay, is equal to $100,000, okay, as per the day of transaction. At that point in time, the spot rate then was 63.7. Therefore, the payment in cash shilling as per the month of December was equal to 100,000. Okay, here we multiply because you're converting from dollars to cash shilling from the stronger to the weaker one. So you multiply 63.7, here therefore 6.37 million. Okay. At the point of settlement, when you actually pay in the month of January, okay, the rate have moved from 63.7 to 21.2. Therefore, at the point of payment, a settlement date, this is called the settlement date. Okay. The amount you meant to pay, it doesn't change, it's $100,000, sorry, at a rate of 71.2. Therefore, this gives 7.12 million. As you can see, between the date of the transaction and the date of settlement, okay, there is what called adverse movement. You're going to, at the point of settlement, you pay more than what you had planned for in court, okay, at the point of the day of the transaction, okay. Therefore, the difference is referred to as the exchange loss. Okay, would you therefore, how much is it by then? $0.75 million, I'm guessing.
Yes, 750,000.
Therefore, you may recall an exchange loss of 750,000. Okay, that is simply because of there's nothing that just happened. It's only that the currency, this called adverse movement of the currency to your position. In case you are an exporter, then in this scenario, you'll be very happy. If you are an exporter, okay, if for example you have a customer who is meant to pay you $100,000, okay, then for you you'll be making a gain. Because in case you are receiving, okay, if you receive the money today in December, for example, this is the amount you're meant to have received. But if you receive the money, the same amount of money in January, this amount to be receiving. Therefore, in that context, therefore, this is not a loss for you. Okay, in case you are an exporter, it's a gain to you. Okay, so you can call a gain as well as a loss. However, it's still a risk. Okay. Of course, the concern is more towards the negative, but don't forget, even in the case of the positive, from what we're expecting, is still part and parcel of the risk. Okay, the movement from the mean, it can either be from a positive or a negative side, but the concern is mostly definitely on the loss-making side. Then you have got the risk what we call economic risk. And notice that economic risk is simply a long-term version of the transaction risk. We simply try to observe what will happen, okay, to the NPV. Okay, now you're looking at the NPV. Okay, the impact of the foreign currency rate movement on the present value cash flow. Okay, of if for example we have an investment, let's say EABL. Let me just use the example of EABL. Okay, where they do buy barley from farmers. Okay, from South America. Okay, you pay them in not in pesos most of the time. You pay them in US dollar. Okay. It implies for in case we as EABL, okay, you have this project, okay, you have this particular type of, let's say, beer you want to be making, okay. Do not forget that most of your payment you're making, most of your raw material, you pay in dollars, okay. So in case, for example, the currency become weaker against the dollar, what happened? Therefore, you end up paying more to your farmers, okay. In dollars, is the same amount of money. However, upon converting to your local currency, cash shilling, you're going to have more cash outflow in terms of payment to the farmers. Okay, in Uruguay or in Peru, whatever you buy those berries from. Okay, the imply therefore you as the EABL. Okay, your currency in this case, cash shilling, if it becomes weaker, it has a negative impact on the it has a negative impact on the cash flows. Okay, you have more cash outflow in terms of payment to the farmers. Okay, if you manufacture a commodity, however, the market is not clear market. Okay, you do sell to let's say Seychelles. Okay, you make a commodity, you sell to Seychelles. Okay, now what happened therefore in case cash becomes stronger? Okay. If that's the case, okay, if cash becomes stronger against the dollar, therefore it means you're going to be getting less money. Okay, you as the Kenyan company who sells to a foreign market. Okay, if cash becomes stronger, then you get less revenues. Therefore, it has a negative impact on the value of the cash or the project, or the NPV in short. Okay. referred to as the economic risk. It's more of a long-term version of the transaction risk. Lastly, we have called the transition risk. Okay, we call the transition risk. Now, generally, okay, when it comes to consolidation, okay, I think you've done consolidation of the subsidiaries accounts, okay, back to the parent company accounts, okay, consolidate the accounts of the subsidiary and the parent, okay. However, in case you have a foreign subsidiary, okay, in case you have a foreign subsidiary, for example, Equity Bank Kenya, okay, what is called Equity Bank Holding, okay, it owns Equity Bank Rwanda, okay, I think Equity Bank South Sudan, okay, Equity Bank, there's Congo, they even have subsidiaries in Congo, okay. Now, what that implies therefore is that don't forget, you as Equity Bank Holding, you have to convert the subsidiary accounts back to Kenyan shilling, okay. You don't report them in what is franc, okay. You don't report them in South Sudan pound. You don't report them back to, okay, Kenyan shilling. You know, as you do the translation of the accounts of, let's say, Equity Bank Rwanda back to Kenyan shilling, what happened? Okay, you may have an instance where the assets, okay, of this bank, Equity Bank, okay, are more than the liability. Don't forget the accounts of Rwandese bank, okay, they are balancing, okay, if you prepare them in Rwandese currency, okay. However, upon translating them, okay, to Kenyan shilling, okay, you can have an instance where the assets, okay, are higher than the liability. The difference is referred to as the translation gain. If, however, you have more of a liability than assets, okay, upon you translating the accounts of the Rwandese bank, for example, okay, back to Kenyan shilling, okay, then you make a translation loss. But don't forget the account was balancing before. You know that it wasn't balancing. It was balancing. It is not balancing because you have done the translation of the accounts, okay, from Rwandese franc back to Kenyan shilling, okay. In that case, therefore, we refer to that as a book loss, okay. It's a notional loss. It's not that the account was not balancing. The account was balancing even before, okay. But because of translation, it ended up not balancing, okay. So you make a gain or a loss. So there's no actual money you have received or actual money that you have spent, okay. It's only that the accounts that were being translated from one currency to the currency, you end up making a loss, okay. So the concern for this is a bit low, okay. The concern for the transition risk is a bit low, okay, because it's a notional loss, okay. It's not an actual loss that you do incur as a company. Now, the next question that you need to ask yourself is that why do we have therefore a case where the rates are fluctuating? Okay, today is US dollar to Kenyan shilling is at 105, 106, 113. Tomorrow it can be 102, 108. Okay, now what determines therefore the movement? Okay, what determines this currency movement? Okay, there are no factors. Okay, of course the key one is the demand and supply. Okay, if the market is a free market, okay, where the force of market are meant to play without any intervention, okay, then the demand and supply become the key factor, okay. That participant in the foreign currency market, what do they demand of, okay? If they demand more of Kenyan shilling, then of course Kenyan shilling becomes weaker, stronger, okay. If they demand more of US dollar, okay, then of course US dollar becomes stronger, okay, and of course therefore the Kenyan shilling becomes the exchange rate becomes therefore makes it weaker for Kenyan shilling versus the US dollar. So what is the demand? Okay, what does the participant in the foreign currency market want? Okay, of the currency? Okay, when you have the inflation, the other factor is what called the inflation. Okay, inflation simply is the loss of value of money. Okay, which I think you have mentioned that in the past. Okay, the loss of value of money. Okay, definitely, if you have a currency, we have a country where there is more of inflation, then no one wants that to invest that in the economy. Okay, which means therefore, if you have, let's say, a simple example, if you have Kenya, Uganda, for example, okay, Kenya, the inflation is, let's say, 10%. Uganda is 3%. Where do you want to invest your money in? You want to invest where there's less loss of value of money. Therefore, in Uganda, 3%. In Kenya, it's 10%. So you don't want to avoid investing in a country where there's high inflation. Therefore, since you are avoiding, what does it mean? It means the demand of that currency is low. That means, therefore, the other currency is stronger than this currency. The other factor is the interest rate, okay? Definitely, in case you are an investor, okay, and you have option investing in Kenya, Uganda, of course, what do? You're going to view which market do I get more return? Okay, the return you get is the interest rate, definitely. Okay, so which market do I get more return? Okay, as an investor, if I invest in Kenya, I get 2%. If I invest in Uganda, I guess I say 10%. Where do I invest my money? In Uganda, definitely. Therefore, the Uganda shilling has more, therefore, more demand. If you have to compare the case of the Kenyan shilling. Okay, that's the interest rate. Then BOP. BOP is simply the import and export. Okay, in case the country there's more of import than the export. What does that mean? It means that the consumers in that particular economy, they want more of foreign goods as opposed to the local goods. But imply therefore, if you have more of import, it means you buy more from outside market. Of course, if your currency is weaker, because don't forget, you don't buy in your currency. Okay, you don't buy in your currency. You buy for example, in US dollar. Okay, therefore that means therefore your currency is weaker compared to the US dollar, because the import you buy them in US dollar. Okay, therefore you demand more of US dollar as opposed to you selling goods outside and being paid in local currency. Okay, or being paid, for example, in US dollar. So there's more demand for US dollar if you have more of, for example, imports than the exports. If you have more of exports than the imports, for example, in case you have more tea farmers who sell tea, okay, to the European market, for example, okay, what happened therefore? It means that context, therefore, you're going to be receiving more US dollar, okay, ensure therefore there's going to be more supply in the country for US dollar, as opposed to what you be spending in terms of the imports, okay, if you have more of exports than the imports, okay. Now, also another factor is what we call the market expectation. Okay, how do we expect the market performing in the near future? How do we expect the Kenyan economy is going to perform, better or worse? If worse, what do you think the investor will do? They'll pull out of Kenyan market. Okay, the demand of Kenyan share becomes therefore weaker. Okay, if the market expectation is that the Kenyan economy will be improving, what happened therefore? Then we have more FDI. Okay, foreign direct investment. Okay, therefore more dollar comes in. Okay, this explanation. Lastly, we have the point of speculation. Definitely, this is the foreign currency is just like in the commodity. Okay, so the black market might come in here. Okay, in quote. Okay, there might be a holding of currency. Okay, don't forget the case will be holding of currency. Then of course, supply in the market is going to be decreasing. Okay, you will remember this term. Okay, currency holding. Okay, so in case there's going to be someone who maybe a bigger participant in the market want to reduce supply of the economy, what can they do? They can take their investment in the market, their commodity, in this case the currency, and hold it, okay, for a number of for some time. Okay, so since the supply have decreased and the demand maybe doesn't increase, it remains constant. Don't forget, in case you decrease supply, of course, therefore the price of the commodity is going to increase. Okay, in this case, therefore, the currency that is being held by the corrupt participant, okay, therefore is going to make sure the price increase, okay, and as it increase, they're going to release it bit by bit, okay, so it's called an element of holding, okay, and of course in the 2011 to 12 there, okay, Kenya was having this particular case here, okay, holding of currency by the banks, okay, anyway, you can try to do a simple Google search, bank holding of foreign currency in 2011, okay, there's a saga there, okay, anyway. The next policy is the guiding policy, the intervention by the government, okay, and it's more or less we can play on the Chinese market, okay, what happened most in the Chinese market, okay. And the government says that the foreign currency, especially the US dollar, okay, the movement should not be more than 2% of what was the opening value. Okay, so the government intervenes. Okay, so it doesn't matter what the demand and supply is. Okay, so the government intervenes. So the laws of demand and supply may not apply in that particular economy. Okay, simply because of the government intervention. Clear? Now, these factors you mentioned here, okay, we are going to discuss them as theories. Okay, or referred to as the theories of foreign currency theory. So the first theory is called the purchasing power part theory, okay, which I think I've already described indirectly. Okay, under this theory, we are trying to say that the currency that is going to be the country that is going to be having more inflation, what happened to the demand of the currency is very low. Okay, so no one wants to demand that, no one wants to buy that currency because hey, if you have more inflation, then there's more loss of value item. There's more loss of value. Okay, now those countries that therefore experience higher rate of inflation, therefore say they are therefore the future spot rate will be their currency will be depreciating in value. Okay, their currency will be depreciating in value. Why? Because no one demand of their currency. If I invest in a country and my money is lost because of inflation, why do I want to invest in that country? Okay, so no one demands that currency. Okay, therefore you have a scenario where the currency will be depreciating in value. Okay, that's as per the purchasing power theory, which implies therefore if we have two markets, okay, let me give the case of Kenya, Uganda, okay, you have two markets, okay. The commodity, in the case you have one commodity, okay, let's say you have if you have a piece, you have a car, okay. So the price of car in Kenya, okay, if it's 1 million, let's say it's 2 million cash shilling, okay, it ought to go at the same price, okay, in the Ugandan market, okay. Of course, after converting this 1 million cash shilling back to Uganda shilling, okay. So that commodity need to go for the same price, same exact price also in Uganda, okay. What called the law of one price, okay, the law of one price, okay. That if a commodity, the commodity need to go at the same value in the other market. If not, of course, therefore there'll be what called arbitrage. Okay, someone can decide to, if the car is in Uganda is more expensive, why don't I buy in Kenya? I sell in Uganda. Okay, so the law of the arbitrage will therefore step in. Okay, otherwise, okay, if we assume that the law of one price will be applied, okay, then the currency, if maybe the car was 1 million, okay, let me just give an example just to explain the point here. So if, for example, you have here Kenya, okay, let's use this example of our car, okay. So if this is today is November, so if November, the car was going for 1 million cash shilling, okay, and the rate today, I'm not sure what the rate today is. Let's go to the spot market. I'm sure to go to Equity Bank, we see what rates are giving the customer. Uganda shilling versus Kenya shilling. It's not working. It's not working. Okay, you got a shilling. Let's look at it here. What about this franc? I want you got a shilling. Hey, it's not a month. Okay. I seem not to get you got a shilling. What's happening here? Hey, okay, it's not among these ones. Quite surprised in the case. Just only for years though. I'm not sure other banks they do so. KCB. KCB Kenya. There's no forex here. What's happening today? Okay, it's not to get one here. Hey. Okay, let's just leave it. Let me just use a hypothetical case here. I wanted to use a spot market, but seeing what we can get the trade. Anyway, assume that currently one cash shilling is equal to 20 Uganda shilling. Therefore, the same price of car here, okay, in Uganda, okay, it ought to go for let's say 20. Therefore, this will be therefore Uganda shilling 20 million. Okay. So if in years time, okay, this is let's say 1 year later, okay, if the inflation in Kenya will increase by 10%, okay, therefore the price of the same car will be 1.1 million in a year's time. In Uganda, if the inflation was, let's say, let's how much it will be, let's say 5%, for example, therefore the price of the same car in Uganda, therefore, will be equal to 20 million times 1.05 to give us 21 million, I guess. Confirm, 21 million.
Yeah.
Not 21 million. Therefore, you can see therefore that 1.1 million is like equivalent to 21 million. Okay, that's 1.1 million cash shilling. Okay, this is cash shilling. Okay, is equal to you got a shilling. Okay, 21 million. Therefore, you can say that therefore we expect therefore that the quotation should be like, okay, 21 million divided by 1.1. Okay, therefore how much? We want to determine what is the quotation here, okay? Because 1.1 is equal to 2.21. So therefore, what's the quotation here? 21 divided by 1.1, and we get 20 point.
19.09.
19. Get 19.09.
Yeah.
19.09. Therefore, that's therefore the quotation, therefore, in a year's time, therefore, of 19.09. So in a year's time, the spot rate then it will be 19.09, purely based on the price of the commodity, the law of one price. Okay. Now, what does it mean? Don't forget here, this was a quotation before 20, it has decreased to 19.09. I mean, therefore, that the Uganda shilling is becoming stronger because don't forget, one shilling was equal to 20. Don't forget, at today, one shilling of Kenya was equal to 20 shilling of Uganda. That's today. A year later, one shilling of Kenya is equal to 19 shilling of Uganda. So Uganda shilling becoming stronger, Kenya shilling becoming weaker. Why? Because of it has more inflation, 10% compared to 5% in Uganda. Okay. Clear? Okay, I have an example here. Why untempted?
I got 4.63.
4.63. Okay, great. But therefore, we can now determine therefore that the quotient today, okay, I can say therefore that like what you just done in that example of Uganda, we say that the future spot rate, okay, I call it S1, is equal to the current spot rate, okay, which was 20, okay. The quotation was given us Uganda shilling, okay, per Kenya shilling, okay. This therefore is what we call the price currency. This is the base currency. Therefore, the inflation in Uganda was 5% times 1.05. The quotation in Tanzania, in Kenya, was 1.1, and we got 19.05.
09.
19.09. Okay. So therefore, from this you can be able to summarize and say therefore that the future spot rate S1 is equal to current spot rate. Okay. We multiply by 1 plus the inflation, okay, H in the price currency, 1 plus the inflation experience in the base currency. Simple as that. Okay. So if you have to apply this, so here where H, so where S not, I actually have it here, I have the formula here. So you know, copy this formula, maybe it can help you out. Okay. So apply the formula. So you can therefore the future spot rate, this at the end of the period, S1 therefore will be the current spot rate, which is equal to 4.5. 4.5. The quotation is dollar per pound. Therefore, dollar is a price currency. The inflation in dollar is 6%. Therefore, 1.06. We divide by the inflation experience in the pound. Don't forget the pound is the one that is below. Okay, therefore, what's called the base currency is 3%. Therefore, 1 minus 0.3, and we get 4.6.
Yeah,
No, 4.6 something.
3.
63, okay, which is dollar per sterling pound. Okay, that's on the purchasing power parity theory. In short, you can be able to estimate what to be the spot rate maybe in a year from now, okay, purely based on the inflation rate differential between those two countries. Okay, you can be able to estimate that in future what will be the spot rate we apply 3 months from now, 6 months from now, simply by observing the inflation rate differential between those two countries. Okay, Kenya, Tanzania, Kenya, Uganda, okay, two countries, you can both simply be able to determine what will be the future spot rate simply by observing the inflation rate between those two countries. Here, the examiner is going to give you this equation. However, there will be no explanation. So only what you have in the exam is simply this equation here, but nothing else. So you should be able to apply it in short. Sakina?
I used some other method, but I got 4.63.
You got 6 points?
4.63, the same answer, but I didn't use the formula.
So I didn't get you very clearly. You used what?
I used my own method.
Yes, and you
and
got
I
what?
got the answer.
Okay.
Same answer. I did €1. 1 sterling is equal to 4.5. Is that dollars? Yeah, dollars. Then I converted the 1 and 4.5. 1 into 1 times 1.03%.
Yes,
I mean, sorry, 1.03, and 4.5 times 1.06.
Yeah, I get it.
And then I changed that into 1 again.
Yeah, you can do that. You can do that for sure. It's the same thing like what you just done. Okay, the only difference that here you're applying the formula. But even if you get the formula, you can use that way. You can even fix a commodity. Okay, at the price of you fix a commodity. What the price if you have a commodity that goes for UK for $100? What will be the price it's in UK? Then you inflate the price of that commodity. Then you convert back. You can do that for sure. There's no problem. You can do that.
Okay.
Okay, like just what you've done in that price of a car in Kenya, convert back to Uganda shilling a year later. You can do that, but it will take you. If you get the formula, you can do that for sure. There's no problem. Okay, the other factor which I think we mentioned was on the purchasing power parity theory. Okay, the purchasing, I would call the interest rate parity theory. Okay, the interest rate parity theory, and we mentioned that in the economy where there will be more interest rate to be offered by the market. What happens that more people demand of it. Okay, more people will be demanding of that currency. Okay, why? Because there's more interest to be offered. So therefore, to ensure, don't forget, the market will have to ensure that there's no what called arbitrage. Okay, the market will have to ensure that you don't get any profit for doing nothing. Don't forget, if you invest in Uganda where there's more interest rates, okay, and someone invests in Kenya, the only difference between the two of you is simply because of you invest in Uganda and then invest in Kenya. There's nothing you have done extra. In short, okay. The market therefore will ensure that all participants in the market will be getting the same return. Okay. So one of the things that the investor would, if you're a Kenyan investor, you invest in Uganda because there's more interest rate. One of the things you can try to manage your risk. Okay, is to enter into contract with the bank. Okay, tell the bank that hey, I've done my investment in Uganda. Okay, I'll be earning let's say 10 million Uganda shilling in 6 months time. So I want in 6 months time to sell to you whatever I'll be getting. Okay, so you enter into agreement with the bank. Okay, you enter agreement with the bank. Now the market will act in such a way that okay, the forward rate. Okay, don't forget these are forward now because you want to agree the rate today. the forward data that will be given will ensure that the investor in Kenya and investor in Uganda, at the end of the day, once you convert back to your local currency, you get the same return. Okay, you get the concept that if you invest in Kenya and invest in Uganda, at the end of the day, the total return you'll be getting in cash sharing, all of you, the two of you, is equal the same. So in case you invest in a market where there's more return, then the market will ensure that you're going to be given a quotation that lowers your return. In short, the forward rate, okay. So since this time we have said that the investor will prefer to invest in Uganda because there's more interest to be earned there, okay. There's more return to be earned there. Then the cash sharing, the forward rate quotation will therefore be depreciating to ensure you don't earn any extra interest. In short, therefore, the currency that will have or will be offering, the country that will be offering more interest rate than the other currency, that country that has more interest rate it is offering will have to see its currency depreciate. Why? So that once the investor convert back to their local currency, there is no any extra return. In short, you're going to get more interest, that is a plus, then there must be a minus to ensure that you end up where you are. Okay, I hope that's clear. So since you're going to get more return, plus, okay, we have to ensure that that plus is gone. In short, there should be a minus. Therefore, there'll be a negative, okay, to ensure that you go back where you are. All of you go back who you earn the same return, all of you, okay? That referred to as the interest rate parity theory, okay? In short, where is it summarized? Let me summarize it here, okay? So I want us to go first here, okay? In short, it is said that the country that will be having, that will be offering higher interest rates, okay, will see the forward rate, okay, for its currency depreciate in value, okay? So it has to be the opposite, okay? We want to ensure that every investor in the economy earn the same interest rate, okay? So in case you invest in Uganda where there's more interest rate, once you convert back to Kenya shilling, all of you, whether you invest in Kenya, you invest in Uganda, you have the same interest rate. So since there was more interest that you used to earn in Uganda, then it means you have to subtract some of those interest through by giving you a forward rate, a quotation that will wipe out your extra return. Clear? Okay. And this is the quotation they normally use. This is called the interest parity theory equation. Okay, we said the forward rate, okay, is equal to the current spot rate, okay, 1 plus the interest rate in the price currency. Okay, you can place this in the P, okay. I prefer to do that, okay, but this is what you begin by your examiner, okay. You divide by 1 plus the interest applicable in the base currency. Yeah. Don't forget this formula will be given to you by the examiner also. However, there'll be no explanation. Okay, so you need to know how to use it. So we apply the formula through an example here. So go through this example, okay, and we attempt to do it together. Anita. Anita is not in class. Hey, Anita.
Sorry, sir, I don't know how to do your question.
Hey, Daisy, what do you get?
Still doing.
Right. Sakina, what do you get?
So I don't know, I'm stuck.
Hey, Nafisa, what do you have?
Not yet.
Sorry?
I haven't gotten an answer yet.
Hey, Sanya?
So I'm still calculating. Almost done.
So you want to determine what will be the rates to be applicable in South Sudan, okay? So, and you'll be given the forward rates here, okay? So you can decide to use whatever quotation you want to use. You can decide to use either direct quotation or the indirect quotation, what I prefer, okay? So we told that the forward rate, okay, 90 forward rate is equal to 4.7506 will be equal to, okay, the current spot rate, 4.725, okay. We multiply by 1 plus the interest applicable. The quotation is the NF to the dollar. Okay, this is a quotation NF. So therefore, the numerator is the NF. Okay, the rate for NF is 7.5, but this annual. But this is 90-day forward. So you convert from being annual to a 90-day rate. Therefore, it's equal to 0.075, okay, times 90 out of the risk 5. We divide by 1 plus the interest applicable in the base currency. Therefore, the interest applicable in the base currency, therefore, will be equal to simply divide. Okay. Okay, let's just convert this so that we don't have a lot of work here. We just convert this from being 90-day to from the annual. So the 90-day rate for NF is 7.5% times 90 out of the 60. And you get how much? 2 point? No, is it 2 points? Or 1 point?
1.85.
1.85. Okay, therefore 0.0185. Therefore, the interest applicable, therefore, in the base currency, okay, is equal, therefore, equal to 4.725. 25, you divide by 4.7506. Then multiply by 1.0185 minus 1. And get how much?
1.3%.
1.3%. Therefore, the 90-day forward rate is equal to, therefore, the 90-day interest rate is equal to 1.3%. Okay. Therefore, the annual rate, okay, in case you want to have them at the same base, therefore, be equal to this 1.3%, but for 90 days, because this was a 90 days here. Okay. Therefore, 90 days, the same thing. Therefore, for 100 annualized, this one, therefore, will be 1.3%. Okay, multiply by 360 out of 90 and get 5.2%, I guess. Okay, we are going to use
5.27.
5.27. Okay, 5.27. Therefore, we are meant to use the 5 days and use the 60. So, is there any is there any difference by the way? Because I've seen the day
I
here.
used 365.
Okay, great. Thank you. This is 5. Okay, so this is 5, not 360, and this is 365. 365. Okay, so don't forget, be very careful with the tenor. Okay, the life of the forward. This is 9 days. They don't mix, therefore, the annual return with the 90 day. Okay, so in case of this annual, like an example here, this was an annual return. Therefore, converted from being annual to 90 day. So the two have to match. In short, these two have to match. If they don't, then you're going to end up with the wrong answer altogether. Okay, clear. Daisy.
Yes, sir.
The next theory, which I think we mentioned, was the theory on expectation. I think we mentioned that how do we expect the market is going to perform in the future? Okay, do we expect the market to be a good performer or a bad performer? Okay, if the market is going to become worse off, that's the case of Kenya, compared to the case of Uganda, then of course Uganda, then the Kenya shilling will be depreciating over time. Okay. Therefore, we can use the forward rate, okay, as what we call the unbiased predictor of the future spot rate. Okay, we can use the forward rate as the unbiased predictor of the future spot rate. Okay, therefore, you show that the rate that is predicted by the interest rate parity theory can be equal to, okay, the rate that is predicted by the purchasing power parity theory. Okay. That's what we want to mean. That the two equations, the purchasing power parity theory, okay, and the interest rate parity theory, okay, will give us the same results. Okay, that's what we want to mean under the theory of expectation. Okay, which might make sense. Okay, because if an economy is going to be managing its foreign currency, then what happens therefore to the interest rate? Okay, it'll be offering less interest rate. Okay, that's the ideal. Okay, yeah, if the market is going to performing poorly, okay, then what happens therefore? Because of high inflation, they have to offer the investors high interest rates. Okay, this is called the theory of expectation. The next theory is called the Fisher effect theory. Okay, the Fisher effect theory. Okay, if you remember when we were discussing on how to appraise in the case of an inflationary environment, okay, in the case of an inflationary environment, okay, we did say that at the end of the day, okay, the return the investor will be getting, okay, will have to compensate them for the extra inflation that their market that they are being exposed to. Okay, so in case you have a case where the market is experiencing high inflation, then the investor will demand high return. Okay, that's what we did at the Fisher effect. Okay, and we did this under the Fisher effect equation. Okay. Which means, therefore, the return the investor will be getting, okay, after the compensation of the inflation is all referred to as the nominal rate of return. Okay, I think you should remember. And the return the investor will be getting, okay, without the inflation, okay, we removing the inflation is what we refer to as the real rate of return. Okay, the real rate of return. Okay, and therefore, once we factor in the inflation, we convert the real rate of return into the nominal rate of return. Okay. Now, applying the same knowledge which we did then, okay, we have called the international Fisher's effect theory. Okay, we see that at theory, okay, the nominal return the investor do get, okay, the difference in the nominal return that the investor do get, okay, is it can be explained, okay, it can be explained by simply the inflation rate differential between the two countries, okay, that at the end of the day, the real return to the investor is the same. Okay, the real return to the investor is equal. Okay, irrespective of where you invest the money. Okay, if you invest in Kenya, you invest in Uganda, the return to you, all of you, is the same. If Uganda is offering you more return, it's simply they're offering you more return because there's more inflation. Okay, if Kenya is going to give you more return, it's because Kenya has more inflation. In short, okay. Therefore, at the end of the day, the return to the investor, the real return to the investor is the same, irrespective of where you invest the market. You invest you do invest your money in. Okay, which implies therefore the difference in the nominal rate is caused by the inflation rate differential because the real return is equal. Okay, so if you have to go back here, just a minute. Okay, if the return here, okay, grab off this. So in case the real return here is equal to this is the same. The difference between, or rather, the inflation is what will be causing this to change. Okay, you can get that point. Okay, that the real return to the investor is the same whether you invest in Kenya, in Uganda, in US, in UK. So if there's a difference between the interest rate the investor gets, it is purely caused by because there's more inflation in one economy than the other. Okay. Therefore, the nominal interest rate differential between two countries they provide or call unbiased predictor of the future spot rate. Don't forget what we said about the purchasing power parity theory, that the inflation rate differential between two countries can be used to explain the change in the current spot rate and the future spot rate. We should remember that theory I think we just discussed right now. Okay, that's the difference between the current spot rate, or rather, the inflation rate differential can be used to explain the change, or rather to predict, okay, the future spot rate. Okay, which I think we did this as we said this given us the future spot rate is equal to current spot rate plus, let's multiply. Sorry, this is multiplying. Okay, S naught times, okay, 1 plus the interest rate, okay, the inflation rate in the price currency, 1 plus the interest in the base currency. This one we already discussed together. Okay, since now you can be able to explain the difference between the interest rate in the Kenya Uganda is caused by the difference in the spot rate. That means therefore you can use therefore the nominal rate to explain therefore the future spot rate. But here the difference between this interest rate is equal to the difference in the nominal rate. This two is equal to the difference in the nominal return, the nominal return difference, the nominal rate difference. Okay, that's as per the international Fisher's effect. Clear? This is what we mean by that. Okay, that the difference between the interest rate, the nominal interest rate, these two, is equal to the difference between the inflation differential between the two countries. I call the international Fisher's effect. The difference between the interest rate, the nominal interest rate, is equal to the difference between the inflation rate differential between those two countries. That is as per the international Fisher's effect theory. Clear? Then you can combine all those theory, okay? The international fiscal effect theory, the theory of expectation, the purchasing power parity theory, the interest rate theory into one equation, which you call the four-way equivalence theory, okay, or model, okay? We see that at equilibrium, okay, that at equilibrium, then it is possible all these factors lead to the same thing, that the difference between the interest rate, okay, the difference between the interest rate, the nominal interest rate, okay, is equal to the difference between, this is equal to the difference between the nominal, the inflation rate differential. This is what I just explained right now under the international Fisher's effect, that the difference in the interest rate is equal to the difference between the inflation between the two countries. And the difference in the inflation rates can be used to explain the change in the spot rate, okay, which you explain under the purchasing power theory, okay. And of course, since this difference is equal, okay, therefore the difference in the nominal rate, okay, can be used to explain the change in the spot rate. I think you've just mentioned right now. And as per the theory of expectation, we have said that, okay, the change, or rather, we can use the spot rate, the change in the spot rate, okay, or as the unbiased predictor of the future of the forward rate, okay. But it is possible, okay, to use the change in the spot rate as the unbiased predictor of the forward rate, or saying the forward rate can be used as the unbiased predictor of the future spot rate, okay. Let me just take you back on that theory so that you see the connection. There it is. Here it is. Okay, the forward rate. Okay, here you go. The forward rate, okay, can be used as a unbiased predictor of the future for the spot rate. Okay, so here, okay, going back to here, that the future spot rate, the changes for the forward rate can be used as unbiased predictor, okay, of the spot rate. And you see that the forward rate, okay, can be explained or is explained by the interest rate differential between the two countries. Okay. Don't forget, the forward rate is explained by the interest rate differential between the two countries. This is the interest parity theory. Always remember parity theory. This is the international Fisher's effect theory. This is on the theory of expectation theory. Okay, the same applies even here. Okay, and this is the purchasing power parity theory. So all those four theory come in play here. We call it as the four equivalence model. Okay, and I hope you're going to go through the question back. You see your examiner asking you to explain the four-way equivalence model. Okay, if you can go to, but right now you can't draw the graph. Okay, so you should be able to explain it. Okay, using words. Okay, because you can't draw the graph. Okay, I don't think there'll be any way you can draw the graph in your exam. So you should be able to explain. Okay, how the entire four more theories, okay, come into play. Clear? Sanya?
Yeah, clear.
Okay, great. Then the next thing, which is the core thing we need to discuss, is how do we manage foreign currency risk, especially the transaction risk. Okay, our main concern, as I mentioned, is more towards the transaction risk. There are ways you can try to do to hedge, to manage your foreign currency risk. One of them is simply you invoice in your currency. In case you're in a company, don't invest in Uganda shilling. Invoice in Kenya shilling. Okay, get paid in your currency. Okay, that's one of the way. In short, you're passing on the risk not to you, but to that other party. Okay, your customer, for example. Okay, leading, you pay in advance in case you can see that Kenya economy is going to perform poorly in the next few days. What do? Pay in advance, okay, or buy the dollars in advance, okay, before the cash becomes weaker and weaker. Okay, you can do leading, okay, lagging, delaying. In case the Kenya economy is doing poorly right now, okay, don't pay right now if it is doing poorly. If there's chance that it might improve, then pay after it improves, baby. Okay, or buy the dollars upon it improving. Okay. Another way is simply matching the receipt and payment. If that can happen, where you as ABL, okay, you sell your beer in dollar, okay, so that you can, and the amount received from the sale in dollar is equal to the amount that you pay your suppliers of raw material, your barriers, okay. Therefore, you have been able to manage your foreign currency risk in an easy way. Simply, you match the receipts and the payment. Okay, if you can be able to match, then you don't have therefore zero exposure. If, for example, you sell both in local market, okay, that is in cash shilling, but as well as you sell in the foreign market, okay, that means therefore you will be receiving, since you sell in foreign market, you'll be receiving the dollars, okay, but you also pay your customer in dollars, so that means therefore you have more and no exposure, okay. If the two can match, then the no exposure you have as EABL, okay. Because the dollar you get from your customer is the dollar you're going to be using to pay off your suppliers. Okay. Then to hedge against the risk of translation, what can you do? Okay, you can, for example, you match asset and liability. Okay, it's not that easy. Okay, which I think as you do your advanced financial reporting, corporate business law, I don't know, corporate reporting, I guess it's called, or SBL nowadays. It's called SBR. Yes, it's called the SBR. Okay, strategic business reporting. As you do so, you'll be discussing how you can, simply how you do consolidation of the foreign subsidiary. Okay, of the foreign subsidiary. Okay. So generally, what you can do is simply you try to see. Okay, those assets we have, we as Equity Bank Rwanda. Okay, those assets that have exposure towards the foreign currency movement. Okay, we match with liability. Okay, such that the two become equal. Okay, so therefore you end up having zero, okay, transition risk exposure. Okay, don't forget, in case you match the asset and liability, okay, then you are able to ensure that there's no any exposure you'll be having. Okay, if the two can happen, you have zero risk exposure. Okay, not so easy to explain. The best way to explain through an example. Okay, which is beyond the scope. Okay. Next is what we call netting. Okay, netting is very simple. Netting is simply telling your customer, okay, no, in case you are, let's say, Equity Bank, okay, Kenya, okay, we provide Equity Bank Rwanda with some services, okay, and they owe us money, okay, and assume that vice versa, we owe them money because either we took a loan from them, okay. So what we can do is that, why don't we, as Equity Bank Rwanda, okay, net off with our parent company, okay. We simply, instead of getting the money, instead of us getting the money, then pay them the money, why don't you owe me and I owe you? Let's just net off the balance, okay. So we simply, okay, have more or less like zero exposure, okay. If that can happen, that would make things a bit easier, okay. Instead of you paying me, that I pay you, okay. That means if I expose you, then you expose me. Why don't we just simply net off the balances? That means therefore you have, but this can only happen in case there's you are my receivable and the same you also my payable. Okay, that's the only time that can happen. Okay? Where we ask, why don't we just net off the balances? Okay, we call netting off. Okay, then these are called, they are called more or less tactical. They're not hedging methods per se. Okay, but they're more towards called tactical methods. Okay, you can use to reduce the exposure towards the foreign currency risk. Okay. And then you have called the hedging techniques, okay, which I don't want to start today. Okay, we call hedging techniques, okay, which we shall start tomorrow. Okay, I don't want to have so many material. I want to go back to you. Okay, so these are techniques you can use. That here you do enter into formal contract agreement. Okay, in order for you to be able to manage your foreign currency risk. Okay, you're going to enter into formal contracts whose main objective is to hedge on the foreign currency risk. Don't forget this method of gesture here, matching, netting, okay. There's no any contract, there's no obligation, okay. There's no any binding contract obligation you need to have, okay. But for hedging techniques, these are going to be contracts, okay, which are going to be binding the two of you, okay. Anyway, so here is where we shall start tomorrow, okay. We discuss on the forward, the money market hedge, the future, the swaptions, okay. So let's take from a pick from here tomorrow. Question already discussed.
Sir, could you please repeat leading and lagging?
Okay, leading and lagging. So here, if for example you owe maybe in 3 months time, okay, you do require to pay money to your supplier, okay. If you go to the market today, okay, maybe currently cash sharing is doing at, let's say, at 95. You suspect or you speculate that in 3 months time, if I wait until that month, what will happen is that the cash becomes weaker, okay. It decreased from 95 to 105. What do? Let me go and buy the dollar today, okay, before it becomes worse off. So that means you're leading, okay. You're going to buy in advance, okay. You're buying in advance, okay. That's leading. Lagging, this is where, so if a customer pays you money today, okay, if you go to the market, you get in 95, the quotation is 95. You know that in 2 months' time, the cash sharing becomes weaker. What do? Let me wait, let me not convert today, but wait until the second month. Then I can go to the market when the cash is weaker and get more cash sharing. This is called lagging now. Okay, leading and lagging.
Okay.
Clear?
Yes.
Okay, great. So, okay, those are some of the techniques you can use in order to manage your foreign currency risk. Any other question? Okay, another question. Great. Then we meet tomorrow. We discuss on the hedging techniques. So we agreed at 10. I will share with you, I think the same link we used last week on Wednesday, the same link we shall use tomorrow. Yeah, so the same link that we shall use tomorrow, the same link. Okay, fair enough. Then see you tomorrow.